Hello friends, at the outset I thank you very much for making SBI Mutual Fund as the fastest growing fund house in the country and crossing 500,000 crore mark, which is a landmark in itself in the history of mutual funds in India. This has happened only and only because of your help, your support, your blessings on ongoing basis. You are aware that we have been offering all innovative products, all kind of, our book is absolutely complete as far as domestic business is concerned. But today when we have become leader, I think it's our responsibility, it's our duty to provide further diversification in the shape of international funds to our clients through all of you. We are starting this journey with an offering of funds of fund of US equity fund, which is being managed by Pioneer through our joint venture partner Amundi. Amundi is the largest fund house in Europe, and they have been providing very good funds across the world for their clients. We feel that this offering will take us to the next level, and you will be able to offer one of the best products in US to your clients. This fund is 93 years old and is being managed with the theory, with the philosophy of sustainability in a very stringent manner. And today we have our friend, my colleague Jason from Amundi to talk about it. Jason heads the international business development of Amundi and is well versed with the product. He has been interacting with the portfolio manager, and he will give us the details about the fund, about the philosophy of the fund, and all the features of the fund which can help us in taking it to our clients.
The backdrop is generally good, especially for active managers. As context, US equity markets had the fastest recovery from a bear market in history in 2020. Vaccinations, economic stimulus, and accommodative monetary policy are paving the way for a strong recovery in the US economy in 2021, as well as a big uptick in corporate earnings. This would normally be a very positive environment for stocks, except that valuations are well above average, especially for high growth stocks, which led the market in 2020 as investors shunned cyclical stocks due to the economic downturn. The strong appreciation in the top 5 stocks, all of which are in the growth index, resulted in a record level of concentration, with the top 5 stocks accounting for 22% of the index at year-end. Due to the current equity valuations, we believe US equity returns will be more modest than the 18% return of the S&P 500 in 2020. We also believe the index concentration presents a significant opportunity for active managers to diversify away from the index by investing in stocks with cyclical exposure that may have lagged in 2020 due to their economic sensitivity. High valuation stocks, some of which are approaching levels not seen since the dot-com bubble, are vulnerable to a significant correction in our view. "2020 was quite a year for large cap growth stocks, with the Russell 1000 Growth Index outperforming the Russell 1000 Value Index by 36% on a one-year basis, according to Morningstar. In our view, this happened for 2 reasons. First, investors have shunned cyclical stocks and favored stocks that have benefited in a stay-at-home environment. For example, equities of cloud computing companies have performed well as more people have worked from home. Second, interest rates plummeted. This has reduced profitability for financials, which is the largest sector in the value universe, as interest rates on consumer and business loans have plummeted. Falling interest rates have also meant a lower discount rate, which has benefited growth stocks as the net present value of future cash flows has increased. The market has begun to broaden, with some value stocks performing well. We think this will continue as the pandemic recedes. As mentioned earlier, S&P 500 index returns are likely to be modest this year, given that valuations are above average. Within the equity universe, however, we believe there is a significant opportunity in two types of stocks. First, quality value stocks that underperformed last year due to their cyclical orientation. And second, stable growth stocks that have moderate growth rates and valuations and were left behind as investors bid up high valuation stocks in 2020. Stock selection, in our view, will be crucial this year to avoid both the overpriced high growth stocks as well as structurally challenged deep value stocks such as airlines, which may never fully recover. Our goal in managing the strategy, which dates back to 1928 in the US, is to outperform the S&P 500 index while mitigating risk. In support of this goal, the team is focused on three things. First, evaluating the sustainability of a business. This is important because the value of a stock depends mostly on what happens in the future, not on the financial results a company has generated to date. We assess sustainability across three pillars: competitive, financial, and ESG. Typically, companies that have leading market share positions, have been highly profitable and growing, and have scored well on ESG factors or have been improving their scores are candidates for inclusion in the portfolio if the risk-reward profile of the stock is favorable. Second, managing risk. A stock must have at least 2-to-1 upside potential versus downside risk based on our valuation analysis, which includes discounted cash flow, as well as with traditional valuation metrics, such as price to earnings. We also consider the potential impact of black swan events, such as Brexit, on individual holdings and the portfolio as a whole. Third, identifying companies that are benefiting from secular trends. There are currently 5 secular trends that we are pursuing: artificial intelligence, automation, cloud computing, the Internet of Things, or IoT, and 5G. While having exposure to these themes is not a requirement for holdings in the portfolio, many holdings have benefited from the secular themes in one or two ways. They've either generated revenues as providers of technology related to the themes, or their competitive positions have been enhanced because they've been aggressive adopters of the technology. An example of the latter is a railroad using IoT, the Internet of Things, to predict equipment failure. The themes, from an investment perspective, are long-term in nature, but they can evolve over time. There are 3 reasons we think the strategy is well suited to the current environment. First, it organically allocates between stable growth and quality value stocks based on their risk-return potential. This means investors in the fund do not have to make a top-down allocation to growth and value, which can be hard to do. We make that choice for our investors on a stock-by-stock basis, which we believe is the optimal approach. More recently, we have found better risk-adjusted return potential in cyclical stocks, and we have been shifting the portfolio accordingly. Second, it has successfully mitigated downside risk. As we discussed earlier, valuations are elevated, making a market correction likely at some point. We think investing in a strategy such as ours that has a record of participating in rising markets while mitigating risk may be the right approach in this environment. Of course, past performance is no guarantee of future results. And third, it provides exposure to long-term secular themes that have been accelerating due to the pandemic. As an example, we believe many employees are likely to continue working from home, at least part-time, even after the pandemic subsides. The strategy currently provides exposure to cloud computing companies, which are benefiting from a work-at-home environment. Overall, our market outlook remains positive, but stock selection is likely to play a significant role in generating attractive, risk-adjusted returns this year. We think the ride will be a bumpy one. We believe this portfolio may be a good option to consider now, given its focus on sustainability, its bottom-up approach to portfolio construction, and its valuation discipline.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.